Hello, everyone. It is Tuesday, August 6th, just before lunch. Hope everyone's having a good start to their week. All right, hands up. Who panic sold? Who freaked out over the last couple of days? Missed out on a little over 1% rally in the market today. I know it's probably exhausting. I constantly say the same things over and over again, but timing the market is incredibly difficult to do. And I know a lot of people did, and a lot of people wanted to sell out in these last, Friday and then yesterday, obviously. And the market continues to punish people who panic in that manner. With the market being up today, you're sold when it's down, you miss the up, and it's just a compounding effect of bad results when you get into that cycle. So we know that's happening because we have the data and statistics to back it up. This is the CNN Fear and Greed Index, currently at a 21 out of 100. Extreme fear, right? The market is extremely fearful of what's coming down the pipe. Now, just a week ago, it was neutral at 47. So we've completely unwound a neutral setting all the way down. We didn't even just slowly tick our way down. It just snapped down into this extreme fear. And this is common. And here's a look at a different type of fear and greed index, but this is a volatility panic index. Essentially, when volatility spikes through people investing in various forms of options to hedge and protect their portfolio, we can track that data. And so we have this huge volatility spike. Now, on the bottom is that volatility panic index, but on the top is the S&P 500. And look over the last couple of years, when we've gotten these extreme moves in the volatility panic index, it's traditionally been a really good time to buy. And based on what the market's doing today, this could be a turn back up to the top. So these quick, fearful reactions are never good. I could talk about this for 30 minutes. I had a really busy day yesterday. Essentially was not on my phone, on any social media throughout the day, and get home last night, and holy crikey, my phone was just covered in sell all your stocks. The stock market's a joke. This isn't going to work. The economy's going to crash. I had people just, I had a clip of Barbara Corcoran, from Shark Tank, the real estate mogul, about how now's the time to get into real estate. Just the stock market's crash, all this stuff that you see when this happens. And you got to remember, folks, like these people made tons of money in 2020 selling you a bill of goods, on all this different form of investing outside of the stock market, when, a little bit of patience in the stock market proves itself again. So let's take the temperature down a little bit. Whatever your plan was on Thursday, your financial plan, your money plan, your budget plan, your investment plan, whatever that plan was on Thursday, it should not be unwound, by Tuesday morning because the market went down a couple of days. It's just not the way to build wealth over the long term. So just wanted to kind of hopefully take the temperature down. Everyone's kind of getting into that panic mode already, and I really think that's unfounded. But let's look a little bit at why the market is in a little bit of panic, and maybe one reason why it's warranted. But there's still a lot of time left. And so this is the SAM rule recession indicator. I shared this a couple weeks back in another market video, but basically it was when the 3-month moving average of the unemployment rate ticked up to the point and crossed a longer term 12-month unemployment rate average. And so we got that last month as expected, and it has been a pretty good indicator of future recessions. Now, everyone wants to say this time it'd be different. Maybe it will, maybe it won't, but it doesn't mean it has to happen tomorrow, right? There's still a lot of good things happening in the economy right now to not enter that extreme fear phase just yet. It's definitely something to be paying attention to, but not a reason to panic sell your investments. We do not know what this is going to unfold over the next couple months. With the unemployment rate ticking up a little bit, it's good to look at history. And we're going to focus on the blue bar here, which is kind of the normal unemployment rate that we see, the U3 unemployment. So currently at 4.3, hit a low of 3.8 over the last couple of years. So it has ticked up a little bit, but you can see the average is 5.9 going back into the 60s. So if we go up from here, yes, that's going to cause an economic slowdown, potentially even a recession. But I think it's a far cry to say that '07, '08 is going to come again. The unemployment rate is going to spike to 10. Now that the Federal Reserve has interest rates to a higher neutral at 5.25 to 5.5, there's room for the Federal Reserve to make adjustments to those interest rates to try to respark the economy and get some of that growth back. So there's a lot of arrows in the quiver this time around. There's a lot of different things that can be done. Again, this is going to take time to fizzle out. So it's not a reason to panic today. With the Federal Reserve's ability to lower interest rates, the expectation is that they do that. A lot of people are saying that they made an error last week and not cutting at their meeting in July. I'm not going to be the one to decide whether I think that's the case or not. A lot of people felt like they should have cut interest rates, and now people are anticipating they cut interest rates by 50 basis points instead of 25 basis points in September to kind of make up for this one and a reaction to what we've seen in the market. Remember, the Federal Reserve's job is not to react to the stock market, right? It's for maximum employment and stability of prices. So they're not going to look at what the stock market is signaling and make an interest rate adjustment. They're going to look at unemployment, stability of pricing, inflation, all of that good stuff. And so I think the Federal Reserve will stay convicted in what their plan is. Probably going to see some interest rate cuts, but I don't expect this, golden parachute to pop up and cut interest rates by 50 basis points in September and then again in November and December and really ease the burden. I don't see that happening. Again, time will tell. But this is the 10-year Treasury yield right here. You can see it's fallen pretty good over the last couple of weeks. These are each weekly little checks, candlesticks as we call them. So we're in a pretty good drawdown here. We're hitting the bottom side of this channel. So we do expect maybe interest rates to float back up. But we do believe the longer term trend is down, which is why we've extended our duration or entered longer term bonds in expectations that interest rates fall, value of bonds climb over time here. So I had an amazing conversation with Janice Henderson portfolio team last week. I have a really good friend, a good colleague that I trust to help me with portfolios, specifically in the fixed income space, and met with him and his team about how bonds were positioned in my portfolio and some different things to think about. And they brought up this Treasury yield curve, and I thought I'd do my best to kind of explain it, how it's working, what it means today, and kind of what that means for our bonds and our fixed income position. So the yield curve is essentially just what the line looks like. Traditionally, it's curved lower on the left, bottom left-hand side, and then goes up to the right as you enter longer term. Right now, we're in that inverted yield curve scenario in which short-term interest rates are higher than long-term interest rates. You can see on the yield on the left-hand side, we were up in that 5% range, still are in that really, really short term. Now, the first little mark, the 3.89, is the 2-year yield. So that's came down quite a bit over the last couple of weeks. But that longer term yield curve is what I want to look at. You can see that's not really moving, and it doesn't move as fast as short term, but it's not really adjusting a lot. A year ago, it was 4.2, currently 4.06 as of yesterday's close. So we're not seeing that long term or the long end of the yield curve move very much. And this is something that team Janice Anderson brought up to me and said, Sean, your position for longer term rates, they might not adjust. That risk of extending duration may not be worth it. It's paid off here in the last couple of days, but that's nothing to worry about. We are looking at that 3 to 6 month time frame to suggest maybe staying more intermediate, even a little more short term, in the expectation that the longer term yields do not move. And why that's important to you is I do think there's this standard principle that everyone believes interest rates are going to go down. I'm going to be able to refinance my house or refinance my car or what have you. And I just don't think that and to their point, that is as guaranteed as maybe a lot of people think. Economy is going to slow down. We're going to go into a recession. They're going to cut interest rates, and I'm going to be able to get a really good mortgage again. Well, that's just statistically probably not going to happen. Currently, the 30-year average is at 6.7%. Obviously, I've said many times that we don't expect anything sub 4, like we've been through over the last 15 years. And you can see since 2008, that average 30-year fixed mortgage has been about 4.4%. So I don't even know if we'll see that, because there's this opportunity for the market and or just banks and lenders to say, hey, we feel this interest rate decrease that the Federal Reserve is going to do is going to be short-term in nature, to just cool the market off a little bit, ease a little bit of that burden, and then we'll kind of be able to settle in and keep trudging our way forward. So, I don't expect the 30-year interest rate to move a lot. And it's so not disappointing and frustrating, just sad maybe in a way, to see so many people right now like extending and putting pressure on themselves and their monthly budgets and their incomes to purchase these houses and do these things that they're doing in anticipation that some savior down the road is going to help them. I would encourage you all to not do that, because we do not believe that we're going to get. It's going to take a pretty good recession to be able to see something come sub 5 into the low 4s for you to get a really nice refinance. So just be super cautious about that and what your long-term plan is and what's most important to you, and make the best decision you can there. But based on my conversation with them and kind of some of the stuff I've seen, I believe that there's a lot of validity to that, and to be cautious on purchasing and being able to refinance. Here's a look at the S&P 500. I just want to share where markets are at. I don't know if you can see this very well on the top hand right, but year to date, this is a global total market index. So just everything across the world, if you just bought every single stock weighted by market cap, the biggest companies are the biggest share of the portfolio, smallest companies, the smallest share. You can see that we're in this nice little channel. The midpoint of this channel and that dotted line, I think, is super interesting. Anytime you get the midpoint to line up to inflection moments is super important. But you can see the market's pulled back 7%. Now we're still up 5.8% year to date, and I think that's why all this fear that has just been pushed on us in the news and in social media about the market crashing is just absurd. The market goes down 5% on average, like 4.5 times a year. It goes down 10%, like 1.2 times per year. So this is just completely unfounded. The market pulled back 9.7%, hit that red line, which is the 200-day moving average, which has historically been a really good barometer of where the long-term trend of the stock market is. I think that's an awesome thing to see, that we were able to cool off 9.7%, touch that 200-day moving average, and now we've kind of slightly moved higher today. Now, I don't expect us to snap back to the top. It's going to be choppy. It's going to be volatile. But until we break that red line, the 200-day moving average, the trend is still positive, and the stock market is still trending upwards. 5.8% up year to date on that global market index leads us to I think that's on pace for like a 9.5, just shy of 10% annual return. I mean, we all would have signed up for that on January 1st. So there's just no reason to be panicking just yet. What we've seen over these last couple of weeks is just totally normal in the market. So don't let what you're seeing and hearing and your friends at work and all this garbage get in the way of what you're trying to accomplish. So the last thing I'll leave, my clients in particular with is to remember the work that you've done, planning your future, designing your life, designing what you want to do with your money, and the work that we've done to build and execute that financial plan, primarily focused around that 5-year income plan. So if you need your money, if you don't need your money in the next 5 years, especially 10 years, this should be just a buying opportunity, right? Keep saving, keep investing. We know what's going to happen over long term. If you do need this money in the next 5 years, you should have already been prepared with your portfolio to go through these times in the market. Even though they're not that bad, we still want to be prepared. And so the work we've done for our clients in building these 5-year income plans, I want you to remember that. believe in that. If you have any questions on it, please schedule a meeting with us. We're happy to update yours or run back through it or kind of outline it for you. But the work's been done. We're prepared for recessions. We're prepared for normal drawdowns in the market. There's no reason at this point in time to panic or alter your investment strategy or your long-term financial plan. So I hope everyone has a good rest of your week. I hope the market climbs back up and kind of eases some of this fear. But if it doesn't, know that we are watching, we're monitoring, and we're prepared to make the adjustments we need to make. So hope you'll have a good rest of your week, and we'll talk to you all very soon.